Okay, let's get into this. If you've been watching the markets um, at all this past week, we're talking the first week of February 2026, you are probably just looking at your screen and scratching your head.
Yeah, absolutely.
Because if you look at the headline numbers, the S&P 500, the NASDAQ, everything looks fine. We're hovering near all-time highs.
Right.
But if you actually own individual tech stocks, especially in software, your portfolio looks like a crime scene.
It's a complete bloodbath under the surface. It is one of the most aggressive disconnects between the market and the components that we have seen in years.
Right. It's not just a little dip. We're
Yeah.
seeing a rotation so violent that Wall Street has actually dusted off a very dramatic, very Hollywood buzz phrase for it.
Oh, I know the one. They're calling it software Armageddon.
Software Armageddon. It sounds like a bad disaster movie.
It sounds totally hyperbolic, I know. But when you look at the capital flows, I mean, the sheer volume of money exiting software, it's actually a pretty accurate description of the sentiment right now.
And that is exactly our mission for this deep dive. We need to understand why investors have suddenly decided, almost overnight, that artificial intelligence is going to eat traditional software.
Is it justified? Is it just hysteria?
Exactly. And maybe most interestingly, we need to follow the money. Because that cash is leaving software, but it is not going where you might expect.
No, it is definitely not. It's heading into some very physical, very old economy assets.
So we have a huge stack of research to get through today. We're pulling from analyst reports at Wedbush, strategy notes from Edward Jones, a ton of data from Bloomberg Intelligence, and transcripts from Yahoo Finance. We are going to connect all these dots.
Let's do it.
Okay, we have to start with the catalyst. I mean, software stocks have been the darlings of the market for over a decade. High margins, recurring revenue, infinite scale. It was the perfect business model.
It was.
So what exactly happened this week to trigger a sell-off of this magnitude?
It wasn't just one thing. It was more like a one-two punch of product rollouts. You had Anthropic releasing major updates to Claude, and then almost at the same time, OpenAI rolled out new features.
But the key here isn't just that the chatbots got smarter or faster, right?
No, not at all. It's that they released agents. Agents capable of doing end-to-end work.
And that is the crucial distinction. We are not talking about a chatbot that helps you write an email anymore. We are talking about agents that can execute complex workflows.
Exactly. And the narrative on Wall Street, it just shifted overnight. The fear is no longer about competition between software companies, Salesforce fighting HubSpot.
Right.
The fear is about the obsolescence of the business model itself. There's this specific concept in the reports called vibe coding.
Vibe coding. I keep seeing this on financial Twitter. It sounds like something teenagers do on TikTok, but the implications for the enterprise are actually pretty terrifying.
They really are. The premise of vibe coding is that using tools like Cursor or Claw, a non-technical founder or, say, a small business owner, can build their own internal software tools just by describing the vibe or the function they need.
Okay, so let's play that out. If I'm a small business owner, instead of paying Salesforce or HubSpot, $50,000 a year for a subscription?
Yeah.
I just tell an AI agent, build me a system to track my customers, visualize the sales pipeline, and send automated follow-ups, and it just does it.
That is the thesis. And it doesn't just spin it up once, it maintains it. So for a SaaS company, software as a service, I mean, that is an existential threat.
Because the whole valuation is based on pricing power.
And if your customers can build a good enough version of your product for pennies using an AI agent, your pricing power is gone. It just evaporates.
And this leads to a financial concept that I really want to drill down on because it explains why this crash is so severe. The analysts are calling it terminal value risk.
Yes. This is so important. Usually, we talk about next quarter's earnings. This is completely different.
How so?
When you value a high-growth software stock, you aren't really valuing what they earn today. You're valuing what they'll earn 10, 15 years from now. You assume they'll grow, capture the market, and then eventually they just print money forever.
That forever part is the terminal value.
Right. But what if investors think AI is going to replace these tools within, say, 3 to 5 years?
Then the terminal value isn't stable, it's zero.
It's zero, or it's shrinking. Right now, the market is pricing some of these software stocks as if they're going to decline by 5% in perpetuity.
So they're treating them like the newspaper industry in 2005.
Exactly. They're pricing in a slow death.
That is just a brutal re-rating. It explains the drop. We're seeing the IGD, that's the big software ETF, down 12% in a single week. That is the worst performance since the 2008 financial crisis.
and it's down 30% from its peak in September. So this has been building, but the floor just completely fell out. Dan Ives over at Wedbush, he's the one leading the software Armageddon chant.
He does love a dramatic headline.
He's a showman for sure, but he's capturing a very real sentiment. The uncertainty is the killer.
Feels a lot like February 2025, remember the DeepSeek moment? When those Chinese AI models dropped and everyone panicked that AI was a commodity?
I do, but that resolved pretty quickly into what they called Liberation Day. This feels different.
Why?
Because the timeline with DeepSeek was about geopolitical shock. This feels structural. It feels like an erosion. Investors don't know which business is going to be replaced by a vibe-coded agent next week.
Is it tax software? Is it legal software, graphic design?
You don't know. And when you can't model that risk, the only safe move is to sell.
Okay, but let's look at the other side of this. Because usually when the consensus is this unanimous, when everyone is shouting software is dead, the smart move is to be a contrarian. Is there a legit bull case here, or should we all just sell everything that involves code?
There's a very strong counterargument, and it's that this is all just mass hysteria. The bull case is that AI is not a zero-sum game where AI wins and software loses.
So it doesn't subtract from software revenue, it adds to it.
Exactly. It expands the TAM, the total addressable market. The historical analogy they use is a great one. AWS, Amazon Web Services.
Okay, walk me through that.
So when cloud infrastructure became cheap and accessible in the mid-2000s, the bear case was, oh no, software companies are doomed because anyone can build software now.
Right, the barriers to entry were gone, so profits would go to zero.
Well, what actually happened?
We got an explosion of new software companies.
Precisely. Cheap infrastructure allowed companies like Datadog, MongoDB, and Snowflake to be built on top of that layer. The argument now is that AI is just a new infrastructure layer. It will make software better, more intuitive, and more essential, not obsolete.
But that implies a flight to quality, doesn't it? I mean, not every software company survives this transition.
No, definitely not. The winners will be the companies that have something AI can't just replicate overnight. Proprietary data.
Okay, so let's get specific. Let's look at the so-called baby with the bathwater stocks. HubSpot is down 70% over 12 months. That is a crash.
A huge one.
The fear is SMBs building their own tools. What's the defense for HubSpot?
The defense is the unified data layer. So sure, you can ask an AI to code you a CRM, but can you get it to integrate 5 years of customer emails, transaction data, website behavior, and support tickets into a single profile that your sales team can actually use?
So HubSpot organizes the mess, and the AI needs that organized data to work.
Yes. Without that layer, the AI is just hallucinating in a vacuum. HubSpot becomes the operating system for the AI agent.
Okay, what about Intuit? TurboTax. I mean, I'll be honest, I've used ChatGPT to answer tax questions. Why is Intuit not the next Kodak? The stock is down 30% this year.
Intuit is a fascinating battleground. The bear case is obvious. ChatGPT, do my taxes. But the bull case is that Intuit isn't trying to be a form filler anymore. They're embedding AI agents to disrupt their human competition.
You mean the local CPA?
Exactly. Intuit wants to replace the $500 an hour accountant down the street. If they can put an AI agent inside QuickBooks that does the advisory work of a human, finding deductions, strategy, compliance, they aren't losing revenue. They are stealing market share from the professional services sector.
So they use AI to move up the food chain. That's a compelling pivot.
And then you have a company like MongoDB. They actually just signed Anthropic, the very company causing all this panic as a customer.
That's ironic. The company destroying software is buying software.
It makes perfect sense, though. AI applications run on massive amounts of unstructured data. You know, JSON files, logs, chat history.
And MongoDB is built for that.
It's what they do. So if you believe AI apps are going to explode in popularity, you have to believe someone needs to store that data. MongoDB is betting they are the vault.
Okay, so the takeaway on software is it's not dead, but the easy money era is over.
Yeah.
You have to pick the companies that own the data, not just the interface.
That's it.
Now let's rotate. Usually when investors flee software, they run to hardware. If we're building all these AI agents, we need chips. NVIDIA's been the story for 2 years. But not every chip company is partying right now.
No, and this highlights a critical bottleneck that is arguably more important than the software panic. The memory crisis.
HBM, high bandwidth memory.
Yes. These AI models, the ones powering the agents we just talked about, they are incredibly hungry for memory. The demand is so high that spot prices for memory are jumping 50 to 100%
Every month.
every single month.
100% a month. That's hyperinflation. How does a hardware supply chain even function with that?
It barely does. And the problem is supply. There are only 3 companies in the world that make this stuff at scale. Micron in the US, and SK Hynix, and Samsung in Korea. That's it.
It's a global oligopoly.
A very tight one. And here's the stat that blew my mind from the Wedbush report. Back in October, OpenAI, just one company, secured 40% of the global DRAM market supply.
Wait. One company bought 40% of the entire global supply.
Yes.
That sounds like Sam Altman went to Costco and bought every pallet of toilet paper before a storm.
That is exactly what happened. He front-ran the market, but because he hoarded the supply, other industries are starving. And the biggest victim is Qualcomm.
Qualcomm. They make the chips for smartphones.
Right. And they are in a real bind. They have demand for phones, but they physically cannot get enough memory chips to put into the handsets. The data centers are sucking up all the inventory.
So the revenue's dropping not because people stop buying phones, but because they can't actually build them fast enough.
Partially, yeah. Handset revenue is down nearly 13 to 15%. And analysts think this shortage is going to last 6 to 8 quarters.
That's 2 years. In the tech world, that's an eternity.
It is. I mean, Qualcomm is trying to pivot. Their automotive business just broke $1 billion in revenue, but the smartphone business is an $8 billion anchor dragging them down.
So to recap, software is under attack by AI agents. Hardware is being strangled by a memory shortage. Where on earth is the smart money going? Because like we said, the S&P is near highs. Someone is buying something.
This is what they're calling the Great Rotation. Capital is fleeing the digital economy and moving into the physical economy, the old economy.
Like what? Give me examples.
Industrials. We're seeing manufacturing activity, the PMI index expanding at the fastest pace in 3 years. Investors are betting on a resurgence in American manufacturing.
And consumer behavior is shifting too, right?
Okay.
I saw a note about goods over services.
Yeah, for the first time since COVID, investors are betting on goods over services.
So the revenge travel era is over. We're done buying plane tickets and back to buying washing machines.
That's what the flow suggests. And usually in a shaky market, you'd buy consumer staples, toothpaste, detergent, defensive stuff. But staples are actually underperforming.
Which seems counterintuitive. If people are scared, they usually buy safety.
It is, but remember, technically, this is still an up market. The index is high. You don't buy defensive stocks when the S&P is at a record. You buy cyclicals. You buy things that grow with the economy. So factories, machinery, automation.
Okay, but what about the real safety nets? You mentioned money wasn't going into Bitcoin.
Yeah, this was a rough week for the Bitcoin is digital gold thesis.
Yeah.
In this specific sell-off, it completely failed as a store of value. It correlated almost perfectly with tech stocks.
Tech went down, Bitcoin went down.
It acted like a risk asset, not a hedge.
So did it act like a hedge? Actual gold?
Real physical gold. Central banks, China, Poland are buying massive amounts. It is being viewed as the true anchor amidst all this geopolitical risk. But the real surprise is silver.
Silver? Really? Silver has been the quiet cousin of gold forever. Why is it popping now?
Silver is secretly an AI trade.
Okay, here we go. Explain that connection. How do we get from chatbots to silver bullion?
Through energy, specifically solar panels. 94% of solar panels use silver paste for conduction.
Right.
We know that AI data centers consume a massive amount of electricity. Some estimates say they'll consume as much power as Japan by 2027. To feed that grid, we are seeing a boom in renewable installations.
So the logic is AI needs power, power needs solar, solar needs silver.
Correct. And look at the cost dynamics. Silver used to make up, maybe 3% of the cost of a solar panel? Negligible.
And now?
Because demand is skyrocketing, silver now accounts for nearly 40% of the cost of the panel.
40%. Wow. That is a staggering increase. It implies that the physical constraints of AI, the electricity, the memory chips, the raw materials, are driving inflation in these very specific pockets of the economy.
We're moving from a capital-light economy where you just write code and it scales infinitely to a capital-intensive one. You need copper, you need silver, you need energy, you need those expensive memory chips.
This brings us to the macro picture. The Fed. If we're moving into this expensive world and tech is crashing, why hasn't the whole market collapsed? What's keeping the S&P 500 afloat?
Liquidity. We looked at analysis from Gina Martin-Adams at Bloomberg Intelligence, and she points to something called the Taylor Rule.
Okay, refresh us on the Taylor Rule. I haven't looked at that since Econ 101.
It's a classic formula that calculates where interest rates should be based on current inflation and growth. It gives you a neutral rate.
Where are we now?
Right now, the Fed funds rate is about 2 percentage points below what the Taylor rule suggests it should be.
So despite all the talk about higher for longer, the Fed is actually easy.
Historically speaking, yes, they are loose. And history tells us that when the Fed is easy relative to the Taylor rule, stocks average an 8% annual return. When they are tight, that drops to 4%.
So the Fed is still providing a tailwind.
For the broader market, yes. But we have a wild card coming. Kevin Warsh has been nominated for the Fed, and the market seems confused about him.
Is he a hawk or a dove?
The Warsh factor is complex. The market sees him as a pragmatist on interest rates. He might cut them, but a hawk on the balance sheet.
Meaning he wants to stop quantitative easing.
He hates it. He believes the Fed buying assets just pumps up stock prices artificially. So investors are getting this mixed signal. We might get rate cuts, which is good, but the actual supply of money, the liquidity might shrink.
And shrinking liquidity usually hurts speculative growth stocks, like tech, the most.
It all circles back to tech. It always does.
Okay, we've covered a lot of ground here. Software Armageddon, the memory shortage, the silver spike, the Fed. If you had to synthesize this for the listener, what's the one thing they should take away?
The takeaway is that we're witnessing a historic bifurcation. We're splitting into two economies. One side believes AI makes traditional software worthless. That's the Armageddon crew. The other side believes AI is just a tool that makes software essential.
And in the meantime, physical reality is catching up.
Right. The so what here is that the era of growth at any cost is hitting a wall of physical constraints. You can't just code your way out of a shortage of high bandwidth memory or a shortage of silver.
I want to leave the listener with that concept we started with, terminal value risk.
It's the most important concept to understand right now.
Usually applied to stocks, but I think it applies to careers too.
Yeah.
The market is ruthlessly pricing these software stocks based on whether they are AI enablers or AI victims.
Absolutely. If the market believes a tool or a job is obsolete, it doesn't matter how profitable it is today. It matters what the value is 5 years from now.
That is a haunting thought to end on. So ask yourself, is the tool you use at work getting smarter, or is it just waiting to be replaced by a vibe-coded agent?
It's the question of the decade.
Keep learning, keep questioning. Thanks for listening to The Deep Dive.
See you next time.